Okay, greetings, everyone.
Hi.
Thank you for attending. Again, today's workshop is going to be on 6 really easy ways to increase your credit without paying off debt. I'm Dr. Dominique Reese. I am a financial coach. I serve LA County, and I help my clients with anything that impacts their money. So today's workshop is really about actions that you can take within the next 30 days to increase your credit. Now, we've had other series workshops where we talked about what is a credit report, how to pull it for free from all 3 bureaus. So if that's something that you feel like you want to know more about, I can send you the recording for that as well. We had a second workshop, which was based upon reviewing your credit report. Once you get it, what are you supposed to do with it? How are you supposed to review it? How do you know what to look for? Well, that was that workshop, and we covered that information. Again, if you want that recording, I can send it to you. So today's series is the third workshop in the credit series, and we're going to teach specific actions you can take to increase the credit score without paying off debt. And I'll tell you why that part is important. It's important because most people will get their report, review it, and then start to decide which items I'm going to pay back, right, in order to increase my score. Well, paying off debt doesn't necessarily increase your score. It actually may not have any impact on your score if other things are going on. So I'm going to teach you what those other things are, teach you what your credit score is, the Fico score, what your score is made up of, and then those 6 actions. So that's what we're going to cover today. If at any time you have a question, raise your hand, we'll answer real time. Or you can write it down and we'll do some check-ins and we'll have a question period. Here's a little bit about me. Again, Dr. Dominique Reese. I have over 15 years in the industry. I am 34. I am young. Most people say, oh, you look like you're 20 or something. Well, thank you, Father. I receive it. But I've got over 15 years in the industry. Hi, thank you for coming. And I love the work I do. I started off as a financial advisor with Merrill Lynch. I help my clients manage about $4 million in assets. Back in 2008, 2009, when everything was going to hell in a handbasket, so did my job. I got laid off. I decided to start my business in New York City, teaching people about money, helping one-on-one, doing budgets, saving strategies, and debt reduction strategies. Fast forward to now, I moved back to California in 2012, started working at a financial startup in the Bay Area, got laid off again. A week later, after getting laid off, found out I was expecting, I was going to become a mom. So now I was laid off, no job, and I must be a mother. So I've been through some things, and I understand what it's like to hit financial rock bottom. I've hit rock bottom twice, even as a financial professional. And I share that with you to say, I'm not immune. I just have the solution. So once I hit rock bottom, I knew what to do because it's the work I do. But I wasn't prepared for that, and most people aren't. So I definitely bring not only what I know, what I've been trained to know to the table, but I bring my personal experiences as well. So please believe this is a safe space. Feel comfortable to share what you like. You don't have to share anything. But I would love for you to feel like this is a safe space. And if you have any questions, please ask. No question is a stupid question. Sir James. This is my associate financial coach. He's working with me to learn a little bit about what I do, running a business, and the work we do in the industry as financial coaches. So he will be assisting us today. James, could you go ahead and click the mouse for the next slide? Thank you, sir. So again, we're going to cover what is a credit score, what is a FICO credit score, why is this score important to your financial life, and then we're going to talk next steps for after the presentation.
So I don't need to take a picture of anything because it'll be right on your.
Absolutely. I
Thank
can
you
send
so
you this presentation as well. So you don't have to take any notes, maybe
Oh,
just
okay.
some questions. Yeah, I'll totally send this out to you. You're more than welcome. And I might be able to print it even while we're here, so you can have a copy. But I'll email it so you have a soft copy as well. So what comes to mind? I'm sorry. What comes to mind when you hear the phrase credit score? Anyone? Shout it out. Debt. What else? Feelings, thoughts, anything.
Hold you back, yeah.
Do what you want to do, hold it back. What else? What else comes to mind? Any feelings that might come to mind when Right. Sometimes I get a little tense, like not anxious, but there's like that feeling in your chest. You just kind of knot it up. What is it going to be? Did it go up? Did it go down? And then you finally look and you're like, okay, whatever it was, right? So there's a lot of emotion that comes to mind. There's a lot of feelings that come to mind. As a financial coach, I encourage you to honor that. What does that mean? Well, if when you hear a phrase like credit score or any other money related phrase, and you have a reaction to it, that is your natural senses telling you this is an area that's important to me. Pay attention to it. So we all know what's going on in your own situation. Like I said, as a coach, I'm not here to tell you what to do or what's best for you. I'm simply here to support you based on the decisions you want to make. So when you have those feelings or those emotions that come to mind, whether you opening that bill, whether you paying the bill, whether you know you're not going to pay the bill, honor those emotions and at least pay attention to what's happening. Because the first thing is the mindset shift, even with credit. If you have a pessimistic or what we call a limiting mindset around your ability to improve your credit, guess what's going to happen? Whatever you're thinking is what's going to manifest, because what you focus on expands. Money is just not about the numbers, it's about behavior. So a lot of the work that I do is helping clients to shift their mindset first about what it is we're about to get ourselves into. That's why I encourage you to honor those feelings, recognize if you're feeling a little negative about it, that's okay. To learn how to start shifting to a more positive mindset so that once we give you the solutions, they can actually come in. They won't be the things like, well, I already knew that, or I did that before, or I tried it and it didn't work. Well, there's something that you didn't do well or do right, and it could have just been a mindset shift in order to get those results. Please feel free to welcome anyone else.
Okay.
Yeah, no cut off.
All right.
All right, James. So what is a credit score? Any thoughts before I share the answer? Yes, ma'am. Money. Well, I'll tell you this, it definitely impacts your money. So I'm so glad you're here too. Thank you for bringing her. I know you kind of had to, but at the same time, we appreciate it because she's going to get things that most of us didn't get at her age.
Something we should have had in school.
Right, and they don't teach us. Yes, ma'am. Right. It is a reflection of behavior. And that's really all it is. And so I even encourage clients not to get caught up in the score, because a score is a reflection of something else. It's like this audiobook I'm listening to about money, because I always have to work on development. And he says, what you see is a reflection of deeper things. So let's say our credit score is a reflection of what's happening behaviorally, our ability to pay our bills on time. It's just a reflection of something. It's almost like the fruit, but the roots, you are the roots. What you produce are your fruits. So if you want to change your fruits, you got to start at the roots. And that's literally what we're going to do with credit. It's just a reflection of your behavior, your circumstance at the time. It's a snapshot. And so I don't want you to attach too much emotion to it, because one, it changes. Two, it could change without you doing anything. So you literally don't even have control over the scoring, how often things are reported. We don't control any of that. As a coach, I encourage clients, one thing that is never going to change with no matter what we're doing with our money, we cannot set goals around things we don't control. So to the extent that we don't control when they're going to report, we just need to know by when they might report and or what we need to do before the next reporting period. Credit score, perfect. Snapshot in time, just a 3-digit number, reflection of your behavior, and it's something that we can change. James? And Investopedia.com says, a credit score is a statistical number that evaluates a consumer's credit worthiness, and it's based on credit history, behavior. Lenders use credit scores to evaluate the probability that an individual will repay his or her debt. A person's credit score ranges from 300 to 850, and the higher the score, the more financially trustworthy a person is considered to be. That's it. Just like you would loan somebody $100, That's the example we're going to be using today. Do they pay you back on time? Do they pay you back in full? Do you have to find them, or do they reach out to you first? Same thing with our creditors. Are we paying them back on time? Are we paying them back a little bit, all of it, some of it, none of it? And are we dodging that call? Same idea, behavior. So all of those things we can control. That's what we're going to focus on today. Okay? Next slide. Why is this score important to your financial life? Anyone want to share why you think and or why you know your credit score is important? Why?
It helps you to get a job, apartment, car,
Right.
financial, economic, whatever.
Yep, it provides access, right? Any other thoughts about why it's important? Lower interest rates. So when you do borrow, it's going to cost you less, right? I mean, some people could walk into anywhere, not have to put anything down, and still have the lowest interest rate. And it might not kick in until 6 months from now. So it's like, I have access to, come on in, sir. I have access to do whatever, whenever, and it's not going to cost me anything. I'm not even in that position yet. I am steadily increasing my score so that I can just one day walk in, apply, get it, and walk out. I don't even know what it will be for, but that's my goal, to get it to there. Because that's a certain level of access and freedom that we know we all can achieve, but you may not have done it before. If you've never done it before, don't beat yourself up. How will you know to do it if you've never done it before? And I think with money, a lot of times, because we're adults, we just feel like we should know this stuff, right? I'm an adult, I should know this. Don't beat yourself up. If you weren't formally taught, how are you supposed to know? You only know what you've been conditioned to know, based on parents, family, friends, other people in the world, or your own trials and errors.
And I blame the school system as well. Okay.
And the school system,
Oh,
right?
yeah.
And we're actually starting to see a shift in that, thank God. You know, this
Yes.
has been, it's now on the national discourse to talk about financial literacy, to talk about educating people about money. Some schools have mandated through laws and policies that their high schoolers or middle schoolers will get this information. Hasn't come to California yet, but if and when it does, please pay attention to it, because that will be our opportunity to start incorporating this type of stuff into our
I
schools.
did, just to let you know, in California, there's a group of teachers, and
Uh-huh.
they go from school to school, although it should be mandated. I agree.
Right, right. So if there's
But they do
not,
have a
it's
group.
probably the small organic, right?
It is,
Small
it
organic
is.
effort. And that's probably how a lot of things get started. But we want to pay attention to those movements so you know what to support with respect to financial education. All right, James. So what is a FICO score? Let's get it. Next one. Investopedia.com says a FICO score is a type of credit score. So mind you, there are several scores. FICO is one, and it's the most popular. And it's actually created by the Fair Isaac Corporation. Now, if you don't know anything about the Fair Isaac Corporation, I challenge you to Google it. You might be surprised. They're just a regular old for-profit company. They're not the IRS. They're not a government agency. It's literally like Dominique Reese saying, you know what, I'm gonna start a company, and my company is gonna report data on people. And I'm gonna blow up, and I'm gonna buy up all the little smaller companies that report data, and then they're gonna use mine as the primary number. That's literally what happened. Not a government agency, no one to fear. They're not gonna like bang down our doors and arrest us because of our FICO score. However, without the knowledge of knowing, you'll just think that they are a government agency, or you think that the government is involved. Totally not. They're a for-profit company. They buy up the smaller ones, they become a bigger company, and before you know it, we're all talking FICO score as if it's something that the government supports. Not at all. For-profit company that just blew up along the way, and year after year after year, got bigger and bigger, and now there's three major bureaus: Experian, TransUnion, and Equifax. There are actually hundreds of other credit unions, or I'm sorry, credit bureaus, but those are the three main ones, and they report the FICO score. Next one. So what makes up your FICO score? Now, this is where we're going to start talking about the behaviors necessary to increase your score without paying off debt. This is where it gets good. There are 5 factors that contribute to your credit score. James? First factor, payment history. Literally, how are you making your payments? Second, amounts owed, or what we would call debt utilization ratio. Now, this is where you want to look at your credit limit versus how much of that limit you're using. And there's a number that's calculated, and we'll go into that in more detail. Third part, length of credit history. Oh, I just realized I forgot to add something. Okay, length of credit history. That's literally how long have you been building credit? Fourth, taking on more credit. Are you out here in the world applying for everything under the sun? And if so, that's impacting your score. We'll talk about that. And then lastly, the types of credit. Based on credit algorithms, they like to see consumers managing more than one type of debt. And we'll go into the types of debt and how that all works. Now, each of these factors have a certain weight on your score, and that's what I forgot to add. So the first one, payment history, 35% of your credit score is solely determined on whether or not you're paying your bills on time. That's it. Second one, 30%. So that's based on how much you owe. So that's 65% of your score, solely based on paying on time, paying in full, and not maxing out your card. That's it. The fourth one, length of credit history, 15%. The fourth one, taking on more credit, 10%, and types of credit, 10%. So I'll give you that breakdown again. 35, 30, 15, 10, and 10. All of those together make up your credit score. And when I'm actually going to print this out, and I'll bring it down for you guys to have this notes. All right, Jane. So let's talk about payment history. Paying on time and paying the minimum in full. You get that statement in the mail. It tells you what your minimum balance is. Pay it by the due date. Score. You do that over time, it'll increase your score. That's it. So again, you're not taking out any new debt. You're not doing anything different, but just making sure you're paying your bills on time. Next one. Debt utilization, as I said, how much of the credit available to you are you using? Let's see the next slide. Here's 3 examples. Well, 1 example, but 3 accounts. So let's say you have a credit card with a limit of 100, a limit of 100, and a limit of 200. The balance is the amount that you spent on each card. When we look at how much credit you're using that's available to you, that's called your debt utilization ratio. We literally will take the balance divided by the credit limit, and you're going to get a decimal. That decimal is equal to a percentage. So basically what this means is I have a credit card with a $100 balance. I've already spent 50, so my ratio is 50%. I'm using 50% of the credit available to me. That's all this means. So I like to be able to translate these numbers into language so it makes sense, because we're going to be talking about percentages a lot. Again, I have a credit card with a $100 limit. I've used $90. My ratio is 90%. I'm using 90% of the credit available to me. Last example, I have a credit card with a $200 limit. I've only spent $20. My ratio is 20 over 100, so I have a 10% debt utilization ratio. Creditors like to see a ratio of 0.3 or 30% or less. Now, how did they come up with 30%? I don't know. That's just what they came up with. But if you think about it, what does that mean? Well, that means they're using 30% of the credit available to them, meaning for every dollar that they borrow, they're using 30 cents. That's basically what this stuff means. Every dollar that you borrow, you're using 50 cents of it. For every dollar that you borrow, you're using 90 cents of it. For every dollar that you borrow, you're using 10% of it. That's what these percentages and numbers tell the creditors. So why would that matter? Well, if I'm pulling your credit report and I see that you're using 90% of the credit available to you, that might red flag me. Well, why is this person using so much? Do they max out their cards typically? Are they in a situation? Are they cash strapped? what's going on. So I may not want to lend to you. However, if I take into account everything you've got going on, all of your accounts, this is what happens. Next slide, Jane. You'll take the total balance. So all of those accounts that we had added up to $160. So you're using $160 of all of the limits that are available to you. The total limits available to you between those 3 cards was $400. So everything being considered, total balance divided by your total credit limit. 160 divided by 400 for the example that we just saw. That would mean you have a utilization ratio of 40%, which would mean for every dollar you're borrowing, you're spending 40 cents. That's basically what that means. So a creditor might then say, okay, even though they're almost maxed out on one card is actually not maxed out at all, and then the other card is kind of maxed out. When you consider everything that's going on, this is where they stand. 40% is not that far from 30. They're okay. I guess we could go ahead and lend to them. And then you get your approved letter in the mail, and you're on your way. That's usually the thought process behind creditors, right? They're looking at how you're already managing what you have, and where does that put you in terms of the type of borrower that you are. Well, knowing this is important to you for a few reasons, and we'll talk about that in a second. Next slide. So again, if your ratio is above 30%, that's just bad. You want to bring it down to 30. If it's 30%, you're good. They're not looking at you sideways, basically. Below 30%, excellent. We will loan to this person. They can manage their debts properly. They're not overextended. That's basically what that reflects in those numbers. All right, next one.
May I say something?
Yes, go for it.
Respond, please. So if you have 4 cards, you're better off spreading your ratio there or your usage of your.
It
Than one
doesn't
and
matter how
go
you
higher.
calculate it.
It doesn't matter.
You can calculate that same number for each account, just like I did, but once you add it all up, it's still going to equal the same number. So basically,
I mean, don't they base it on that also, that you're using one card? For example, I use one stronger than other ones because my interest is a lot less.
right.
Why would I want to use the other one? But will they look at the negative on that?
Well, they do. They're looking at, so when they pull that report, they're looking at every account, right? But when it comes to calculating the numbers, they're taking everything into consideration and then calculating the number like I did on that second slide. They'll see all of the individual activity, fine. But overall, what does that mean? And that's how to make the decision.
So you're better off spreading them, even though.
Yeah, I mean, there's a strategy to it, but literally the numbers are the same. Okay. Length of history. So that was the third thing, 15% of our score. How long have you been building credit? Next slide. Why is that important? Well, you want to be mindful or think twice about closing those older accounts, right? You hear all the time, well, I don't use that account anymore. I don't want it. That might be the case, but don't close it, because if you do, you're going to lose all of the history you've built. It's better to just implement a strategy where maybe you purchase something once a quarter, you pay it off in full, and you keep it pushing. Now, even in doing that, that does not prevent the creditor from closing your account as well, which they can. At any given time, a creditor can close your account or reduce your limit, which is why I suggest never using a credit card as an emergency fund. Because you might think you got $1,000 on that card, and emergency comes and you find out you got 200. How did that happen? Well, they reserve the right to decrease your limit or close your card at any time. Anytime. So that's why we want to, again, these principles, they're out there, we know them, but when you start to think about it, it's like, well, dang, yeah, if I did that, if I relied on that credit card for an emergency fund and I needed that $1,000 and I don't have it in savings, I'm kind of screwed. And here, all this time, you were thinking, I was going to use my credit card for an emergency account. Don't do it. It will piss you off, quite frankly. It really will. So that's why we want to focus on our savings. We can do this ourselves. We just got to get the discipline and know how to put a little aside and leave it there. The other thing is to open an account ASAP if you don't have any history established. So with people who are building credit, they're trying to build it up. Well, the only way you're going to build it is to go into debt, unfortunately. The other thing you could do, if you had someone who trusts you enough to add you to their account as an authorized user, you could do that as well, where basically all of their good history, all of their good behavior will funnel right to you and establish your credit history on your own report. Even though it's not your card, you've been given authorization to use the card. Any behavior that you do on that card is not going to go under your report. It's going to go under that person's report. So you'll just have to get a relationship with whomever it is to say, well, if I do use a card, I'll pay you back what I use. Whatever that is, you will be able to get their good behavior, not necessarily their bad behavior. So you don't want to choose someone who doesn't have good credit to become an authorized user just for the sake of not having to go it alone your own route. That's really for like when parents might say, well, I'm gonna help my teenagers start their credit. They're 18, I don't want them getting their own card yet. I'll make them an authorized user on my account. That way they have access to the account and they'll also get some of the good behavior that I've established over all these years, and that'll be their first line of credit on their report. Any questions about that? Yes, sir, Ronnie.
Yeah, how long would you have to do that? Build your credit off piggyback off somebody else?
Great question. I usually say about 3 months. Give it about 3 months because one, the reporting cycles are usually every 30 days. So even if you added that person today, it might not show up on their report for another 30 to 60 days, just depending on how it's being reported to whatever bureau that agency is reporting to. I would say go at about 3 months. If after that, I mean, if they literally have no credit, and now they do, you'll see an increase in their score. So within that first 3 months, you should see some changes in the results.
Do you have to purchase anything under your name?
Technically, no. You could just make that person an authorized user. They could never use the card. If the owner of the account continues to use the card or even not, that behavior is going to transfer over. So that the authorized user doesn't have to do anything. Just get it in their name, literally. So if you want them to have it, but you don't want them to have it, just add them to the account. Don't give them a card, and they'll still get the good benefits of your behavior.
What's the difference between doing that and a cosign? If any?
Ooh, okay. Not very much different, because as an authorized user, you're actually just saying, I'm covering whatever this person does, the same way you do with the cosign. So it's not very different at all, which is why I said again, with the cosign, you kind of don't have much control over what they do because you're already cosigning, most likely on the vehicle, right?
Correct.
But on a credit card, you cannot have a card issue. So that would be the way that you kind of get in front of them doing anything that you would approve of. Okay. So what types of debt do you have? So this is where 10%, oh, question, sorry. Hey, Ms. Giselle.
So if say they're doing that they have their credit history, and they start to do that, then is there any way to dissociate yourself?
Yes. You can ask the author or ask the person who owns the account to have you removed as an authorized user. Technically, no. Technically, you can call yourself because you're on that account. So just flip the card over to the 1-800 number on the back, call them up. Hey, I'm an authorized user on this account. They'll be able to verify you. I want to remove myself, and you can do that. Yes. So, but again, if you don't have access to the card, then you have to go through the person who gave you access. But if you do have a card, you can do that on your own. Okay? Question.
If the creditor closes the account out and your report, what do you do about that?
Great question. So, and this goes for anything that's on our report. Anything that's on our report will be reported for at least 7 years. If it's a negative account, if it's a good account, it will be reported for 10 years. After 10 years, it falls off. After 7 years, it falls off, but it will still be reported. Nothing. Well, sometimes there is.
Because it doesn't, it's not in a bad,
Good standing.
but
It's just closed.
they close
Yep.
it, yeah.
So it'll be reported for 10 years, which is good because that's helping your score. It shows positive behaviors and good standing. The minute it falls off, expect your score to go down. Because it's no longer, your score is not being, that account is not funneling in. So people see that, like, I've had good credit all my life, and then 10 years later, something happens, well, something fell off, it's no longer working for them. So they now have to probably, if credit is an issue, implement a strategy to start building the score again. Question.
I have some on my credit, it's old,
Mm-hmm.
but then the creditor, that's what you're calling,
Yes.
will make it seem like this just happened.
Okay, so what you could have been dealing with was what we call time-barred debt. Time-barred debt is what is known as a debt that you are no longer on the hook for. So for example, every state has a statute of limitations for debt. California's is 4 years, not 7, but 4. What does that mean? After 4 years, if you have not made a payment, which means you breached your contract with that creditor, right? The contract said every month I'll pay you back this amount of money. The minute you stop making a payment, if you never make another payment and 4 years have passed, the statute of limitations applies, you are no longer on the hook, meaning they can't sue you for that debt because 4 years have passed, they didn't do it in 4 years, their opportunity is gone. However, what will happen then, let's just say that does happen. Creditor, you ain't heard from them, 4 years passed, you know you off the hook because it's 6 years later. But all of a sudden you get a call about this same account and you're like, I haven't heard from you in a while, 1, but 2, because you attended this, you know, after 4 years, I'm off the hook. So why are you calling me about a debt I don't have to pay for? The creditor, original creditor, could have sold that debt to a debt collection agency. And it is not illegal for them to try to collect on time-barred debt. So what will happen is the debt collection agency will call you just like it was something from yesterday, make you feel like you owe it, have some documents to even say that you do. First thing you want to ask them is this debt expired? By law, they have to answer the question truthfully. And if you feel like they're not being truthful, that's the first thing, because you can then dispute it based on that call alone. Secondly, if they do not tell you, then that shouldn't be the case. They should answer that question.
What's the terminology again?
Is this debt expired? Or you could say, is this a time-barred debt? And they know what that means. So they should answer truthfully. If they don't, red flag number 1, document the entire call, who you talked to, when they call, what they said, and then you can dispute that debt with the credit bureaus. By the time the credit bureaus get that letter and the evidence that you have to support it, more than likely that debt is going to be removed, even if it's not 7 years later. Let's say you're in that 4 to 6 year stage, so you literally have like 1 more year for it to fall off, so it won't be on the report anymore, which is another thing that confuses people. Even though I don't owe it anymore because 4 years have passed, by law, credit bureaus will report it for another 3 years. So that's why things that we don't pay can still impact us. But if we're not on the hook to pay it, that's just a decision that you have to make. Do I want to pay it or not? But paying it off is not going to make it go away. Paying off is actually going to wake it up again. And now your clock will reset and you will have to wait another 4 to 7 years to get that off. So I always suggest when you get that report, and I know you may be eager to see what you want to pay off, nothing. First, we want to review it, make sure that the dates align. If there's anything that's 4 years later, we need to consider whether or not the statute of limitations apply. And if it does, what's the process to go from there? Ms. Giselle.
Okay. So, I do something, but if you live in California,
Yes.
your debt is not paid,
Mm-hmm.
you go by their limit?
Yes.
or
You go by the statute of limitations for the state where you opened the account. Okay? And then if being a resident here doesn't impact that if you open the debt in Wyoming. You're subject to Wyoming statute of limitations, or whatever the state might be. Okay? But I will tell you, most states are like 4 years or less, and there's some states that are 2 years. So it's important to kind of know what state is what if you do have accounts that were opened up in different states. Question.
When does the 4-year time limit begin? When you open the account or the last day you made payment?
Very good question. It is literally the date of the breach of your contract. So if I don't make my payment today and my payment is due today, as of tomorrow, they could charge me a late fee. If I don't make any payments from there on out for 4 years, my clock starts that next day when I did not make that payment, when they assess that late fee. Okay,
You have two co-signers,
okay,
number one and number two.
okay.
What does the law say? Who has to take over, or they can choose anyone according to the
Well,
law?
With co-signers, the only thing that's different is the chain at which they contact you. So if I own the account and I'm co-signing, then I'm gonna reach out, they're gonna reach out to that first co-signer. If they can't get in touch with them, they're gonna reach out to the second co-signer. And it doesn't matter if my name is not on there at all, I'm having somebody co-sign for me and then I'm using the car or whatever, whoever's signature is who they're gonna reach out to.
So it doesn't matter. There could be the same one and two.
Doesn't matter. Both of them will probably get some kind of notification because both of their profiles are at jeopardy. So it's like, well, who's gonna pay? You or you? We're sending out the notice, this person owes, what's happening? So those co-signers are on the hook. Question? Absolutely. And more than likely, going back to time for our debt, what typically happens is you don't hear from them. And you're like, oh, I just got one more month before this falls off or before my statute of limitations apply. And you might get hit with some court documents saying we're suing you for this debt. I'm going through that right now. And so I'm like, okay, what happens is they'll let that 3 years pass. That last year, they start to get aggressive. So they're like, well, let's see if we could get anything from her. What you want to be mindful of, because I got tricked in this way. The company, well, the debt collection agency sent me court documents as if they had already filed, but they hadn't. So they were being deceptive to try to make me pay them. But I was able to figure out this isn't real. I don't even have a case. I can't find a case. There's nothing here. So they were trying to trick me into thinking that they've already started the process. Come on and pay us, and then it'll go away. Well, they didn't start the process. So you just want to get familiar with even that court process if you feel like that could be happening. And you can always call the county clerk to legitimize any paperwork that they may have and that they sent you. I got this paperwork, this creditor is saying they're suing me. How do I know if it's real? Call the county clerk, they'll be able to give you some instructions. Okay. Next one. So back to the types of debt and why this is important. So credit mix is 10% of our score, meaning creditors want to know the type of borrower you are because based on the debt you have, it's a different activity. For example, a mortgage. That's usually a six-figure debt, right? And you know it's the same amount every time, due every month. That's a certain payment behavior. So if you're late on that, that basically tells them, based on the same amount every month, you've got difficulty making payments on that, whether you pay in full or whether you pay on time. Student loan debt, kind of similar, but has different sets of rules. So obviously you don't have to pay it back right away when you finish school. You got to pay it back. But when you're out of school, you have that grace period. So for students, student loan debt could be a little different. Auto loan, very similar to a personal loan, right? You take it out, you know how much it's going to cost you. Every month, same amount, due date, same day. Medical debt, however, no interest rate typically for medical debt. It's one of the lowest priority debts that we want to get to. Now, for some people, it's a little different because if the portion of their debt is medical debt and it's overwhelming, then we would want to address that first. But because medical debt typically has no interest rate attached to it, no matter how long you owe, the amount shouldn't change. So when we're prioritizing our debt, we want to prioritize those debts that have interest attached to them because it's costing me to maintain that debt. Question?
Okay. Is medical debt is the only debt you have?
Same thing applies. However, it's just a little different because technically, if there was paperwork between you and the hospital saying that I will pay you back according to a payment plan, if that's what you signed, then that's one thing. On the other hand, if you went, got services and just didn't pay the bill, statute of limitations is going to be applicable. So we want to look at every debt in its own right to just see what that case is. But medical debt is also a part of the statute of limitations. store card, that's like going to Target, Macy's, JCPenney, getting a store card, another form of debt. But store card and credit card debt work differently as well. The behavior you're showing there is saying, I get approved for a limit, so I have a certain amount that I can spend. I spend the card up, I pay it down, I have more available to me. I make more payments, I have more available to me. I go out in the world, I spend some more, I make some payments, I have more available to me. It's revolving. So you might hear credit card and store card debt referred to as revolving debt. Well, it's because it revolves around how much you pay and how much is available to you. So if that's the only debt you have, then you're telling creditors, I'm okay with managing this kind of debt. I get a little bit, I make some payments, I get more. I go out in the world, I spend money, same cycle. So that creates a behavior on your payment ability, your payment capability. Question.
Do you ever talk about payday loan debt? Not that I use it, I'm wondering how that works.
Absolutely. So payday loans are definitely a form of debt. They're more like a personal loan. So number 8 would cover payday loans. Same idea. You know, the only thing with payday loans though is that based on them hidden fees, that debt could be costing you not to pay it. So while you might have only borrowed $200, if you haven't paid that $200 back, you might owe more than $200 by the time it comes back to you. So those debts take high priority, not because they take high priority because the interest rates are so high. So if you find that you're struggling to pay back those debts, we would want to attack those first and create a strategy with them. But they would go under number 8 as a personal debt. So we do cover it. And then past due debt. Past due debt are the debts of, like, let's say old Verizon account or old cell phone account. Maybe you just forgot about it. Who knows? Like, but it's one of those things that you just kind of forgot about. It pops up on your credit report, and you're like, oh, okay. Well, it's going to be the same amount every time. It might even been sold a few times. It might be on one report, not on another. Past due debts are just those old utility service bills that you might have forgotten about, don't even know you owe it, but it's also a form of debt that demonstrates your behavior. Now, for that might just demonstrate you open stuff and you don't pay it back. So again, the creditor is going to glean some information based on the type of debts that you're managing. And then lastly, tax debt. That kind of speaks for itself. So if you're not paying your taxes, you know who your creditor is, the IRS. They're really not pulling no reports. They got all the information they need to get at you, but it is a form of debt that could show up on your report. Inquiries. So inquiries impact your score. They're only 10% of your score, but that 10% can matter, especially if you're like between fair and good. This could be impacting you going to the good stage. So they matter. 2 types of inquiry, soft and hard. The soft inquiry does not impact your score. And it does not impact your score because you didn't initiate it. Usually this is where you get those pre-approvals in the mail, right? Pre-approvals are given to you based on any old company that goes to one of the major bureaus and says, hey, we want to pull all of the people with a credit score between 300 and 500, because they know those people are challenged. So they might be trying to get you a secured card or whatever it is. They want to push this product in front of you. The credit bureaus sell our information to them, and then before you know it, you're getting that pre-approval in the mail saying you've got a pre-approved credit card. How did you get my info? I didn't give you my info. You didn't initiate it. But when they pull your report, that will not impact your score. It will show up on your report. So if you pulled your reports right now, you could look at every company that has pulled your information. It's going to be under the section of your report that says these inquiries are not impacting your score. Hard inquiries, on the other hand, are impacting your score. They're initiated by you, meaning you went out in the world, you saw something, you wanted to apply for credit, and you gave them permission to pull your report. That inquiry will impact your score. They stay on your report for 2 years as well, but they can be disputed. So I'll give you an example of when you would want to dispute inquiries. Let's say you're trying to get a car, and you know when you're sitting in that agency, they're calling their lenders, right? So they may have several lenders, but the one that they're on the phone with is gonna pull your report. Because sometimes they operate in a network, that means Ally's gonna pull, Chase gonna pull, Wells Fargo's gonna pull. But you didn't sit there and do business with nobody from Chase, from nobody from Wells Fargo, nobody from Ally. But when they pull your report, it's gonna show up on the report.
And all those,
All of those,
all those.
everyone. So even though you're dealing with the dealer's dealing with the banks, you didn't walk into those banks and say, pull my report. So when you see them on your report, which they will all show up, you can dispute each and every one of them through a process that I can give you support with. And basically what happens is when the letters get to the credit bureau says, okay, she's disputing this inquiry, let's reach out to Ally. And Ally will say, okay, we don't have any relationship with her. There's no paperwork in our office. She didn't come in and say, pull my credit. We can't furnish anything to validate this debt. It must be removed. And so you'll see those inquiries removed because you didn't do business with them. The dealer did. The dealer called and got all these networks of lenders to pull your report. So you can dispute inquiries. They do impact your score by 10%. And there's a process to do it through the dispute process. Next slide.
Staying on this area.
Okay.
No, it's okay.
Mhm.
Because I heard this a while back, and
Yeah.
if you do a couple of inquiries, you go to the 2 car dealerships.
Yep.
You buy from none, but you go to a third one that you do buy, because that's what you're interested in.
Okay.
Does that take a negative impact or better
Absolutely.
one way or the other? Okay.
You've had, so because you went to 2 different ones
Mhm.
and you said, go ahead, I give you permission to pull my report. So they're hard inquiries. However, you could dispute them because if in the end, this isn't the 100% way to dispute it, but this is what I would do. I would say, I didn't do
And
any
the same
business with them.
process as you did
Correct.
the previous.
I didn't
one.
do any
Okay.
business with them. I didn't sign any deals with them. They just kind of were checking me out. Let's remove that because it's impacting
There
your
was
credit.
no business.
Right. But you still disputed. So here's what you came for. 6 easy actions to increase your score. Now, there's strategies with each of these, and we'll talk a little bit about it. But what I want you to realize is 1, 2, 3, about 3 of these actions are directly factors of your credit score. So your credit score is made up of paying on time and paying in full. Well, if you do that, you're going to increase your score. Hands down, over time. More, and then pay more than the minimum balance. Exactly what I mean. Even $1 more, $2 more, but there's a strategy to that. We'll talk about it. Increasing your limit. Didn't mention that, so we're going to go into detail about what that means. Disputing inquiries, just kind of talk a little bit about that. Opening a new account, we hit on that a little bit, and then reducing debt. Now, the whole title of this presentation was how to increase your score without paying down debt. But paying it down is also going to increase your score. So I don't want to make you think not paying it is some magical thing. Paying down the debt is also going to increase your score, but we'll talk about how. So let's talk about the how. For the first one, paying on time.
Now,
How
for
to
your-
do this, oh, go ahead.
Pardon me. For the first time you open, when you first started your credit, would you also encourage to pay down for the extra payment? Some people say, leave it at that and make a full payment, then you mess with it.
So I call those little strategies, tricks of the trade. Depending upon your exact situation, you could want to carry a small balance. But if you're carrying a small balance, that means you're incurring interest. If you're incurring interest, then you're paying more for this debt than you need to. So it's not the go-to strategy. It's not the first strategy, but it could be a strategy we implement based on the person's situation. For most people, no, we're not going to suggest that. We're going to suggest when you make a payment or when you spend money on that card, pay it off in full because you don't want to get charged for that, especially if it's like $30 you use. Pay it off in full. Don't get charged for $30 that you borrow. Okay. So for paying on time, if you feel challenged by paying your bills on time, here's some strategies. Schedule due dates on your phone or calendar. Now, I'm a paper and pen type of girl, so I do all of my budgeting with paper and pen. I can't do the phone because if I lose the phone, there you go. If the phone's dead, I can't put my information in, there you go. Like, we want to do those things that support our natural behavior. So if you're a pen and paper type of person, do your budgeting every month with pen and paper. Don't do something that, oh, I'm gonna try it this way with. Just do that which supports your behavior, because that's what's gonna get you the result. If you're not gonna stick to the strategy, then what's the point? So we wanna do those things that align with your behavior. Automate your payments via online bill pay. It's really cool. Set it and forget it. But I encourage you to do it from your bank. What do I mean by that? You pay your cell phone bill, T-Mobile, Verizon. You could go to their website, open your account, and set up your payment. But now T-Mobile, Verizon, and everybody else has access to your account directly, right? So if they take something they weren't supposed to take, now you got to go through T-Mobile to get it all fixed, whatever their processes are. If you initiate it from your online bank, it's within your bank. Your bank is issuing the money to them. They don't have direct access to your account. So I like to do all of my bill pay from my bank. And then when anything happens, I'm talking to my bank. I ain't got to worry about talking to T-Mobile and all the other people.
Makes good
Makes good sense, right? So you kind of control that part. And then in the event that something goes wrong, you do some risk management. You're talking with your bank. You already have a relationship with them. You're not going to get the runaround as if you're at T-Mobile or one of the providers. So pay on time. That's going to increase your score. And again, if you know right now, okay, I'm not paying my bills on time, just choose one. Just choose one and get started with that one. Don't overwhelm yourself by trying to get it all in order. Just choose one and start the action. Within 30 days, you're going to see a difference. So that's why it's important to just get started. Just choose one, especially if you can't afford to do them all. Choose one. Next slide. Pay more than a minimum balance. So this is great because now we're reducing the debt, but they're telling you on that minimum balance, because based on the law, they have to tell you how long it's going to take you to pay off this debt if you keep paying at the minimum balance, right? We don't want that. Pay a little extra, but first check your budget. I always have clients say, okay, well, I'm going to pay extra this month. But then that 200 extra you took really shouldn't have been 200. Maybe you should have did 50. Because now you're in another situation. We don't want that. We want to try to get one solution, not create more problems. So check your budget first. Make sure you can afford to spend a little bit more. And don't feel embarrassed by what you spend. I had one client say, well, if I can't spend 20, I don't want to spend nothing. Well, what good does that make? They don't care. And the less you spend, the better for them. So spend whatever you can, $1 more, $2 more. And when you do, call them and say, I want to apply my overpayment to the principal. If not, they will apply it to the interest, which means they're getting their money first. And your principal is still sitting there. And they're going to calculate the interest based on the principal. So if your overpayment goes to the principal, your principal is going to go down. By the time they calculate the interest again, it's on the lower amount, not the higher amount. So that's why it's important. Even if you automate your payment, call them and say, I have an extra payment coming in automatically. I want the overpayment applied to my principal. Question. Depending on the creditor, they may. They shouldn't necessarily. They should be able to offer you an alternative. Okay, well, we do it like this here. They shouldn't just be like, oh, we don't do it, we can't do it. You should be able to talk to someone, even a supervisor. I always encourage that, to say, okay, well, what is your policy on overpayment? What they might do, and I would still suggest you do it, but what they might do is say, well, in our terms and conditions, we have our policy there. Okay, well, can you email that to me? Because literally, it would be in there what they do when you apply an overpayment. But if you're like, I don't believe that, send me the terms, I can review it. And here's why this is important. Every rep is not trained the same. So you can call one day, get one rep, and they're going to tell you one thing. You call another day, get another rep, and whole nother thing. Question.
Is unemployment included in that overpayment? Know anything about unemployment?
I do, but I see what you're saying. So if you're saying unemployment, saying you overpaid them.
I worked for many years. I had an overpayment that time with unemployment. They had a lien on my paycheck, and it came out on the paycheck stub where it was taken out every month.
Right.
Then I paid for years, and then it stopped. Then I started getting letters from unemployment, and I owed them money. I called a job
of like right now is
Yes.
still active. So what you might need to do, one, we have unemployment here, so we can literally speak to someone about your situation. Two, very different than that, state agencies. And at this point, even though it's a debt for you, there's something going on. So we need to get in front of whatever that is going on. None of this even applies to that situation. So if anything, we just want to get in front of it, see what's going on, and then
And
be
the
able
people
to
that answer
gather
the phone is
your
so
paperwork.
nasty.
Right, I was gonna say. So there is something you can do about that. In all of these discussions, if you're calling creditors, you're being treated rudely, you're not appreciative of the service that they're offering, including the unemployment office, you can complain to first the CFPB for institution. CFPB is a Consumer Financial Protection Bureau, like a watchdog for us as consumers to protect us from the institution. On the flip side, with the agency, you would complain to the Attorney General. Every state has an Attorney General. It is their responsibility to hear complaints from the consumers. So you will write the Consumer General, or I'm sorry, the Attorney General, stating what your experience has been working with the state EDD office. And then I'm sure the EDD will probably have some kind of complaint hotline or something like that. But you would want to take advantage of every opportunity to make the complaint, because let's just say this escalates and you get some court involvement. You want to demonstrate that you went through every channel to make your complaint and to successfully resolve it. Not that you were dodging it, not that you weren't in the know, have your paperwork and all of that. Gotta go? Okay. Did you sign? No, you didn't. Okay. I want to make sure I capture who's here. And then I have flyers as well, but you don't have the flyer. Let's sign that. Thanks. So yeah, you definitely want to.
So I can talk to them today?
Yeah, I can connect you to a rep before you leave, if you have the time.
Okay, can you connect me to them now, and I can always come back.
Come back. Okay.
But I need to see about this $10,000.
So what I would suggest is head out to the front desk, ask them that you need to speak with an unemployment benefits specialist.
And then, I'm not gonna talk to that black lady out there. She told me to be talking to her. She's very rude.
Okay.
She is very rude.
So what I can offer is after my presentation, you and I can work one-on-one and I can connect with someone. Okay. All right, next slide.
I don't know.
Increased limit. So this one is really cool. Now, what this does is it impacts your debt utilization ratio. Call your creditor and request the credit limit. So going back to those examples, I had a credit limit of 100, 100, and 200. So in that example, if that's you, right? You got multiple accounts, different credit limits. The one that's in good standing, so let's just say for my example, it was a $200 credit card. I would call them up, I'll say, hey, I would like to request the credit limit of 500. So now my credit limit will go from 200 to 500. That's $300 more. But what that does is it shifts your debt utilization ratio. So before, I was only using $20 of the 200 available to me, and that was 10%. So now if I'm using, let me see, do the math, right, 4%. So let's say I call and they approve me for a $500 credit limit. Now I'm only using $20 out of my 500. My credit utilization has dramatically dropped because I got an increase. So whereas before I was 10%, right? 200 was my limit. I'm using 20, 10%. Now it's 20 over 500. I'm only at 4%. So I went from a 10% utilization to a 4%. That's huge. So it's really looking like you're not using the card at all. You spent 20, you got 480 available. And all you did was ask for an increase on the limit. Question.
Is that bad? You get a credit card for a certain limit, is it bad not to use it, even if it's something like, just something small, you don't use it all the time, is it bad? Is it?
Great question. So I don't want to say it's bad because I don't want to use that language. But what it does impact you. Here's how. Creditors, like I said, can close your account at any time. They even may charge you what's called a non-activity fee. You're not using the card, we're going to charge you $35 a month. Whatever that might be, it's in their terms and conditions. So if you don't use the card, you get hit with the fee. If you want to use the card, I say buy something very minimal, once a quarter, once a month, $20, pay it off in full. That way you don't carry interest and you demonstrate to them you're actually using the card. Don't cut me off. Don't close my account. But yeah, that's how you do that. Question? So increasing the limit will definitely increase your score. Like I said, based on that debt utilization ratio, that's what's being impacted. And debt utilization is 30% of your score. So again, just by paying on time, paying more than a minimum balance, and increasing the limit, that's 65% of your score. You do any of these three actions, you're going to see a change in your score within the next 30 to 60 days. I say 30 to 60 because creditors typically report every 30 days. But depending upon your cut off date, and if your payment was applied before the new statement went out, all of that kind of stuff, that just impacts whether or not it'll show up on this report or the next one. So 30 to 60 days. Question.
When you owe something, you pay it when the minimum payment is due, or do you pay it like 2 weeks before?
Great question. As long as you pay it by the due date, you're good. Let's just say, because every credit is different, I know Target for sure. If you pay 1 day late, they will hit you with the late fee. And it very well could show up on your credit report. Whereas Ally, for example, for your card note, they give you a 10-day grace period after the due date. So you get 10 more days, and then they hit you with the late fee on that 10th day. So really just understand the terms for each creditor, because they're all different. And then ask specifically, when will the late charge hit if I don't pay by what date? And for this in particular, ask if they're going to pull your report with respect to giving you an increase. I want to make sure I tell you that, because if they do pull your report, ask if it's going to be a soft or hard inquiry. Sometimes it's considered a soft, sometimes it's considered hard, which is why I want you to ask. Because once you ask, they'll tell you, and then you can make the best decision as to whether or not you want to go through with it. Because if you do go through with it and they're pulling and it's going to be a hard inquiry, realize that's going to impact your score.
You mentioned something a few seconds ago.
Mhm.
You may ask the wrong person who does not know.
Right.
All right. So car dealership, who do you ask? The manager, finance manager, rather than the salesperson, right?
Right. You will always want to go above their head. So supervisor or a manager.
Get the right
And then
answer.
document that experience. Like whether you're there or once you get home, went here, talked to this person, they told me this, date and time. Always document your experiences with creditors, because you never know when you might need that information or how it might come back to you. Next slide. Disputing increase. So again, 10% of your score, not a whole lot, but can make the difference between you crossing over into a new rating. Dispute each inquiry with the credit bureau. So when you pull your reports, it's going to show you all of your inquiries. If you want to dispute anything, the letters are going to go to one of the 3 credit bureaus. These are the dispute letters. So you might have heard of the letters, right? Well, these are the dispute letters. You send the letters off, they have 30 days by law to get back to you. They don't get back to you within those 30 days. Technically, anything that you were disputing within the letter must be deleted. So when you start sending these letters, it's important that we send them certified mail, because that's how you'll know when they've received your letter, and the time clock starts from there. Okay? So disputing inquiries can increase your score just by getting them off of the report, because they contribute to 10% of your score. Next slide. Opening a new account. So this is also going to impact your debt utilization. While we don't want to have to go into debt in order to improve our credit, it's the nature of the system. So if you want to increase your score, 2 things you can do. Open a new account. Traditionally, we taught a secure credit card, right? It's kind of safe. You got to put a deposit with the card. It's linked to the cash that you add. Very small limits for the most part. Some of the secure credit cards have annual fees. If you don't want to go that route, do one of these things. Open a merchant or store account. One in particular that I've found and that I've researched is My Jewelry Club. Now, what these services do they don't necessarily run a credit check in order to give you the account. What they may offer is like a membership fee, join for $100. That membership fee gives you access to the account. So you're kind of basically paying for the credit at this point, but it's just a one-time fee. What then that'll do is, because they're online, they typically have high balances, high limits. So you might get approved for a $5,000 account. But again, how does that help you? Well, now your credit limit for that account is $5,000. And if you spent zero, you're not using any of it. So you have a really good debt utilization ratio. But compared to everything, when you consider all of your accounts, that $5,000 is helping, right? You don't have to spend it, you don't have to use it. It's just a strategy to increase the score, right? So we're not doing it to actually spend and buy stuff yet. It's to get the account on your report with that $5,000 balance. And within that next 30 days, you should see an increase in your score. Question.
For example, I've been receiving stuff here, but I haven't get anything yet, but it's the same thing as my insurance cover what you claim.
Right.
Okay.
So more than likely, no credit check. So to even get the account won't hurt you on the credit side. Right. Easy approvals, and decent balances, like $1,500, $2,000. So if you don't even have any credit cards with a 4-figure limit, this is a really cool way to get the limit. Again, you don't have to spend anything. Just be mindful of your behavior. Just get it on your, you want that line item on your credit report with that balance.
You said that these can actually apply for and get them at ease, basically easy and
Right.
your credit score.
Right. And it's increasing your score. Why? Because of the debt utilization. So now I have an account on my report that's $5,000 and I haven't used any of it. So when we calculate those numbers again, how much of the credit available to me am I using divided by the total limit of all of my credit, that number is going to go down now that I got this $5,000 account supporting me. So it looks like to the creditors, oh, you've got $6,000 available to you with all of your credit cards, and really you're only using $500. Well, once you add up everything that you're using from all of the accounts, if it's $500 and now you got this $5,000 credit limit, that's a really good ratio.
And they report to all the bureaus.
They may not report to all the bureaus. So a good question would be, what bureaus do you report to? Typically, they're reporting to TransUnion and Equifax. I found that Experian tends to be one of the more stringent companies. So everything is like big major companies are reporting to Experian, and Experian is reporting all of the details. Question?
Now, when you pay your mortgage,
Mhm,
if you make 2 payments a month
mhm.
rather than one, it benefits you. If
Absolutely.
you can do it.
Yes.
Can you do that with a car?
Absolutely.
Right.
And with the car, you definitely want to make sure you call and tell them, I want the entire next payment applied to my principal.
Correct.
Because if not, they may pay the interest first. So you'll make a $400 payment, 300 of that payment might go to interest, and only 100 might go to the actual money you borrowed. So it's always important to call and say, my additional payments, I want
Even
to-
if it's not an additional payment, but just cut in half, just to
No.
the factor that you are paying earlier than the end of the month.
No, it doesn't matter when you pay,
It is.
as long as you pay them before the due date.
Correct.
Okay,
correct.
and then if you're paying an additional payment, you want to call and make sure that they have that payment applied to the principal. Okay. All right, so these are some of the accounts you can start with. Do your research. Again, make sure it's something you're comfortable with, you understand the terms, but this will help increase your credit score within 30 to 60 days because you're impacting your debt utilization ratio. Next slide. Reducing debt. So obviously, if you do none of these other 5 things, you're just left with reducing the debt. However, we want to do it strategically. Start by checking the budget. If you don't have a budget, you need to create one before you do this, because your budget is only going to tell you how much you can afford to pay comfortably. Not going to tell you what to do, not going to tell you what not to do. It's just gonna tell you what to do comfortably, what you can afford to pay extra. Complete a debt analysis. What is a debt analysis? It's literally a piece of paper where you write out all of your debt, interest rate, the balance, the credit limit, and your due date. And you prioritize the debt according to what's most important to you. Not necessarily according to the highest interest rate, not necessarily according to the highest balance. While those are debt reduction strategies that you can Google anywhere, I always suggest prioritize the debt according to the one that is getting on your nerves the most. Because it may not be the highest balance and it may not be the highest interest rate, but you just don't want to deal with that particular debt anymore. Prioritize it and put all your extra money to that debt. Once if that debt is paid, then you could prioritize according to balance or interest rate or whatever. Or maybe it's still whichever debt is going to give you the best peace of mind. Get rid of that one first. That's what the debt analysis does. And then we create the debt reduction strategy. So the budget has basically said you can afford to put $50 extra towards whatever debt you want. That's what the budget told you. You go to the debt analysis. Okay, well, which debt do I want to put that $50 towards? You choose the debt. You set up the payment. Okay, call the provider. I'm going to be sending in an additional $50. I want that applied to my principal. Can I have a statement to show that that's what's happening? Done. So now we've checked the budget, completed analysis, and you have an actual strategy. As you make those payments, obviously your balance is going to go down. You're impacting your debt utilization ratio. You'll see an increase in your score. When that ratio goes down, your score goes up. You have an inverse relationship. Questions, Giselle? You sure? Think about it and come back. Okay? Let me know. All right, Sir James, next slide. Any questions? I know we answered along the way, but anything coming up? Consolidate. So, as a coach, my perspective on consolidation is it's a great solution when it's a great solution. It may not be the best solution for everyone. One, primarily because finding a reputable consolidation company can be a challenge. So one, think about what we're doing. We're saying we're consolidating the debt to make the payments easier. What does that really mean? Either a lower payment monthly or a lower interest rate. Now, technically, you can negotiate those terms on your own. You just can't. Most people just don't know how. So first thing. So then our question, well, if we can do it, why hire a company? Second thing is, understand every process involved. Every debt consolidation company doesn't work the same, but most typically work like this. How are they able to get something for me that I can't get for myself? Well, most times they're not. They will have you redirect those payments that you would have been making to them, and they'll collect that money and it will sit in an account. All the while, the bill that the money was supposed to be paid for is not getting paid, and then is now in a negative status. Most times, that's when they come in to negotiate, because they have better negotiating terms when your account is already in a negative status. So they got to get the account to a negative status, which then could mean your credit's being impacted because now you got a late payment. But no, I sent you guys the money to make the payment. Well, their process doesn't work like that. So you want to be sure that you understand the consolidation company process. If I send you this payment, what happens after I send you the payment? How do you get me better terms that I can't get on my own? So usually after a conversation with clients about consolidation companies, we come to the conclusion that we could probably do some things on our own before we need to actually research and find a reputable source.
And if you do go through them, don't go through the ones that are charging, go through a nonprofit one, because they have them.
Right, you have nonprofit resources where you could either get no cost or low fee support with consolidating your credit. So while there's for-profit companies that are reputable, again, I don't support any of them, none of them pay me to advertise for them. But to the extent that they're there, we just gotta find them, and whichever one's a good fit for you. Outside of that, there are nonprofit resources that you could absolutely tap into. That answer your question? Okay, got another one? Okay,
So what do you do?
well, depends on what you need. Depends on what you need.
Do you help us file bankruptcy or what?
Well, I can,
Okay.
but first I'm gonna ask you, why are we interested in bankruptcy? What is it that we're being faced with? Because a lot of times, if you have less than $100,000 in debt, it may not be the best solution. If you have $50,000 in debt, it could be the best solution. So again, I'm not a proponent for or against. If it's a good fit, let's explore it. But my question as a coach always starts with what's motivating you to
But do you-
consider it.
Do you file bankruptcy?
I do not. I do not do the process. I would help you find somebody to do it. But that's after we've already discussed what's motivating you to even consider it.
So we're here today for you to run our social security number, to tell us everything that's on our credit report?
Absolutely not.
Okay, you know what? I need to go, because I need to, take care of this unemployment. Who am I gonna talk to up here?
So as I mentioned, after this, I can support you.
Okay, so how much longer you gonna be?
I'm not exactly sure. Okay?
I'm just being truthful.
I listen.
That's why I came down here.
I totally understand. But what you may want to remember, be mindful of your energy. What you put out is what you receive. And be sure you have the goal in mind. When you sit with somebody, what do you want them to be able to do for you? And not just, on a second, and if it's multiple things, understand that you may not get it all in one sitting. And there could be some research that you need to do. Do you have any paperwork with you today?
No, but I got my social security number.
Okay. That may not help us.
Look, like I said.
All I'm gonna say,
Listen,
all I'm gonna say, I'm recording. I'm recording this. I'm recording this. I'm recording it, so I don't want your personal situation on there. And there's nothing I can do in here.
Okay.
So let's just wait till after. I'll be more than happy to work with you. But just understand what we're about to get ourselves into. We don't have any paperwork with you. We may be limited in what we can do today. So I want to set your expectation accordingly. The person you're sitting across from, just because we have your social, doesn't mean anything. We may need paperwork. We may need to have the conversation first to understand what your goal is, what it is you want to accomplish, what you may have already done, and then what we don't understand. So conversation first, set the expectation, let's understand what we can do, and then we could go from there. Okay?
So do I need to get some paperwork before I talk to them?
It would be helpful.
Well, I'm not working anymore.
So
we still
listen,
go back to the employer?
what you've got to realize is at this point, you're fighting a case. You got to build up your evidence. You got to get your paperwork in order to say, well, this is what I have, this is what they told me. Because coming to our office, just because we can look it up on one end, this is the same office you're fighting with. So you got to have your paperwork in order so we can have something to compare and be able to say, okay, well, what's the situation? What can we do to help you today? It may not get resolved today, but if they tell you, bring this back, bring that back, about 5 minutes. Thank you, Ms. Lucy. Based on what they tell you, if you sit with them, I don't want you to be disappointed because you didn't come in properly prepared. So I want to prepare you so we could use the time as effectively as possible.
I thought you would be able to help me. That's the reason why I came to.
What made you think that?
Because this is on my credit report. That's what I'm here for, about my credit report.
Okay, but we talked about something very specific. So realize we're not in a
But then when I
one-on-one.
say the overpayment up there, I just.
Understood. But just realize you can't walk in somewhere and expect to get one-on-one help in a group setting, right? Not gonna happen. We gotta set up a one-on-one. We gotta set up a date. I need to know how I can help you. So I want to set your expectations so you don't walk away feeling disappointed and like we couldn't help you when really your expectation wasn't set properly when we got here. So that's the best I can do, is sit with you, understand your situation, help you prepare for it, so when you come back next time, we don't waste no time. It's effective. Okay? Any other questions? Yes, 1, 2, and 3.
Transferring credit card debt onto a zero balance card,
Got it.
or debit card to.
Yep, understood. Right.
Would you elaborate on that one?
Hmm?
Would you elaborate on that?
Yeah, so in
Please.
transferring balances, and get a zero interest rate credit card.
Oh, I see.
The idea is that if you transfer the balance over, you're not being charged interest. So it should just stay the same. It won't go up.
For a period of time.
However, if you're not going to be able to pay that debt off in full within that 12-month introductory rate, it could not be worth it because once the interest rate kicks back in, now you're going to be charged on it. So we want to be sure that if you do that, the debt reduction strategy is already in place to say every month, I'm making a payment by month 12, I'm done. Okay. And while I don't have any specific resources, I can share some with you. And then if we want to do a one-on-one, we can kind of laser focus in on your specific situation. Second question, Giselle.
Oh, if I'm going back to when you're calling and you're letting them know that you want it to be put to the principal,
Yes.
is there any way that you can get a statement before you make that phone call? Because sometimes people will be like, okay, I'm understanding. Your money is already spent over there. So if they turn around and say, oh, what are you talking about? We never had it. You know what I mean? Unless you have the actual recording of the phone call,
Right.
how can you prove?
So you can, sometimes there's no way to protect yourself prior, but what I will say is they should reference the terms and conditions. So you can say, well, send me the terms and conditions. And if you can, highlight the area where it says how my payment will be applied, because technically it should be in the terms and conditions, which as a client, you would have access to. Have them send it to you, even via email, because they do that now, but they might send it via snail mail, so that's fine. Just have them highlight the area. Once you have that information, then send your payment in, okay? And ma'am, you had a question.
When a potential employer checks your credit, are they looking at the credit bureau or are they looking at the job?
Job number, what do you mean by that?
There's a website that you can go to called the job number, and it has your previous employer. And it's through one of the.
Okay, while I'm not familiar with that tool, I can tell you, when your employer's pulling your report, they're literally looking for character reference, right? What kind of a borrower are you? And depending upon the position you're applying for, if money is related to it, then they want to make sure that you're not predisposed to stealing. So if you're maxed out on your credit card, you haven't paid people back, you're probably not going to get that job if you're handling money because they may think you have a predisposition to stealing because your personals are all jacked up. So that's what they're basically looking for as an employer. It's all behavioral. You pay on time. Have you been building credit for a while? And are you decent? Are you average? Are you poor? In terms of the credit score. Right. Responsibility. That's it. Or character. Any other question? All right. Yes,
I do have one little
yes.
doubt now that I'm retired.
Okay.
Retirement money, and there's different types of retirement money, unfortunately. Let's go through Social Security.
Okay.
It's looked at as income by anybody loaning you, or
It can be.
it can
It
be,
can
but some
be.
don't.
Some
Because
don't.
I've gotten the feeling both ways, and I say, oh, really?
Right. It just depends on the institution that you're trying to get the loan from that's looking at your numbers. Sometimes Social Security is included as income. Sometimes it's excluded as income. So it just depends on the agency and what we're trying to do.
That's interesting. So
Okay.
it's the other end. Okay. 'Cause
Yeah.
I've got that impression.
Next slide. Yeah, you'll get various answers, which is why this stuff is never straightforward. So what I'd like to do is hand out the survey, which you have, James. Can you please hand that out quickly? If you're interested in scheduling a one-on-one, I believe I have your information here. So I will be following up via email. In that email, I'm going to have a link with my calendar. You could just schedule one-on-one. I'll get the notification, and then a day before, you'll get a reminder. So that's the one-on-one. And then the next workshop, Hire Myself, How to Start My Side Business, is on July 23rd, 12:30, same place. So Rodrigo. Do I have time for a one-on-one today? I do not technically, but if we want to do a quick chat or something, we can. I have about 15 minutes. Okay? Yes, ma'am.
Do you have anything to say about loan, things like that, that make you like, oh, I can get a loan and do whatever for a while?
Don't do it.
So my question would be, what's motivating you to ask me to speak on it?
To consolidate, maybe get that and then.
Gotcha.
Consolidate and then just pay. you know,
Understood.
a lump sum.
Right. So here's what I would suggest if that's what you're thinking. If you're thinking, man, I wish I could just get one loan, use that money to pay off all of this, kind of do my own consolidation. Great strategy, it works. Consider lending platforms like Lending Tree, Lending Club. I suggest that because one, their criterion is a bit different, and it's not like you get to kind of choose the amount of the loan you ask for. Whereas if you go to a bank, they may already have preset like $1,000, $5,000, $10,000. You know, I don't need 10,000, I need 5 or I need 3. If you go through a peer-to-peer lending platform, you get to choose the amount that you want to borrow, so you're not taking on more than necessary. And you can just literally Google peer-to-peer lending platform. I don't support anyone in particular, although I have one in mind. I'm an investor on that side. So that's why I like peer-to-peer lending, because as an investor, I can put my money there and I know it's being loaned out to people who might need it, who might not otherwise get approved through a bank. But if you Google peer-to-peer lending platform, there'll be about top 5 reputable companies that will come up, do your research, and see if you qualify for any of those. Their lending criterion tends to be a little less stringent than typical banks. So your likelihood of getting approved is a little better. A lending club, and they're one and the same. Any other questions? Ma'am, did you have one more question? I thought I saw you.
Me?
No.
I wait. One-on-one.
Okay. Gotcha. All right, contact info. So you can reach me here. I'm gonna have James print out this whole presentation. We'll print this out, and then you'll have all of these details. But again, that's my contact info where you can reach me. And again, for 101s, I'll be sending emails out with the link for you to schedule your 101. Any questions for me? We talk about home ownership, whatever you want to talk about in your 101, anything that impacts your money, even if it's like going back to school, getting a job, what else? Education, training. While I'm not the training specialist or the employment specialist, I'm in an office full of them, so we partner. So if any of my clients ever want a job, I'm like, okay, go talk to Ms. Vera. She has relationships with all of our employers, and we'll work with you. I won't just drop you off to her. Because you're my client, we'll still work together to accomplish that goal, and then we'll circle back with any partners that I might refer you to. Okay. Thank you so much for your attention. I also have flyers here with my information, so you can take one, pass it down. Feel free to share it with anyone you think could benefit. Again, I'm recording. Let me stop the recording.